Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, good morning, good evening, good whatever it is where you are. I am so messed up with time because of being in Vegas and daylight savings. I don't know what day it is necessarily. I am Daniel Brooks Klein. This is 7 Investing Now. I'm going to be joined today by Simon Erickson, and we're going to talk about why valuation actually does matter for tech companies. Yep, that tech startup you're investing in that's worth like 2/3 of what Apple is, that might be a consideration. We're going to get to that momentarily. Before we do, we're going to talk about this a little bit more later. A very quick programming note at the top. This is our last show through the holiday break. We'll be back in December, but we know it's Thanksgiving. I'm hosting Thanksgiving. Simon has all sorts of new things going on in his world, so we're going to take a little bit of a break. I'm never sure what I'm allowed to talk about, so I'm always really careful with that one. But I bought a turkey. I'm not making a turkey, but I do have to learn how to cut a turkey. But Simon, so we were going to start by saying that tech stocks have broadly traded at increasing valuations, but that's not unique to tech stocks. I actually looked at, it was my pick 2 months ago, and I went, wait, the price to earnings is what? And then I compared it to other players in that space, and I went, oh, actually, that's like pretty good compared to some of its competitors. And these are numbers that like 10 years ago, I would have gone like, oh, I'm not touching that. The world has changed quite a bit, right?
Oh my gosh, it certainly has, Dan. I'm so excited about talking about this program. We talk about what's going up and what's going down all the time. As you mentioned before the program, the stock of your New England Patriots is going up. It seems like my New Orleans Saints is going down. But we're kind of always perpetually in the market is changing. And so we have to be, as objective investors, looking at what has changed in every single year or every single decade. And so we to start this, to kind of frame the conversation, I wanted to chat about and respond to the quote or the phrase that you might always be hearing about the market is expensive, right? And whether you're talking about cyclically adjusted PE ratios or price to sales ratios or the market of the S&P 500 as a whole, it seems like a lot of people are saying it's either expensive or overvalued, or this time is different, or it's going to correct back. And I'm going to kind of start the program by addressing that a little bit. JT, we have some graphics. If you could show one of them just at first here. This is actually the price to sales ratio of the S&P 500. And you see as it is at 3 times trailing sales right now, Dan, that's actually about 3 times, triple what it was when we went through the recession about a decade ago. And JT, we've got another one. If we could show the PE ratio, perfect, of the S&P sitting at around 30 times earnings of the 500 largest American companies that are publicly traded. And again, if you look back just about a decade ago, that's nearly double, maybe the 15 times earnings that we were back then. And then just one final chart to kind of frame all of this. This is actually the level of the S&P 500. You see there's been some big events over several decades and over long periods of time. Sometimes this actually sells off pretty significantly, but the market continues to march higher. In fact, if you look at the graph on the left-hand side, this is not exactly a linear scale. It just shows you that through good times and through bad times, market endures. Thanks very much, JT, for showing those charts. Dan, I'm excited to chat with you today about not only the state of the market that we're in today and how it's changing over time, but also some individual companies, some good and some bad, that maybe we want to take a closer look at.
So we hear that expensive term, and Max Lucas, we'll get to your comment. Any of you who want to ask questions or comments, we appreciate it. We hear it's expensive, and expensive can mean 3 things, and correct me after I'm done here. One could be it's actually expensive. Like we've seen this. We've seen a darling IPO stock that just goes to valuations. Max talks about this a lot, that it's baking in not only everything going right, but all of those charts you just showed continuing to double and triple. So that could actually be expensive. Then there's stocks like, and I'll use Zoom as an example here. Teladoc might be another good one. We're going to talk about some companies later where it's expensive in relation to where you expect it to be now, but not necessarily where you expect it to be in a few years. So some stocks get ahead of their valuation. Then there's the third scenario where every person who told you Apple, Amazon, and Microsoft were expensive for the past decade, Netflix, there's others, they're wrong. And I've been wrong on at least one of those myself. So Simon, is this just a case of we're going to push valuations higher and expensive is very relative and you need to look at the underlying quality of the company, which by the way, is something that is a cornerstone of what we do at 7 Investing?
Yes, to both of those, Dan. And to address your second comment first, the markets, they are changing as a whole, but also the markets themselves are based on different metrics. And so if you look back a couple of decades, we were kind of going through an industrial phase, right? Big conglomerate companies, the GEs of the world, the energy companies like, the Exxons of the world. People were making stuff and sales were a reflection of that. And then we kind of went through the software phase of like the late 90s and the early 2000s, where it's all about capturing the upfront sale of software titles. And now we're kind of in this software as a service world. We're in this cloud computing world now, where everything is hosted by large companies and their data centers, but it's much easier to capture recurring revenue. And so the market itself is changing a lot. If you look at the largest constituents in the S&P 500, the companies you just mentioned there, Dan, they've changed over time. Right? This is now America's largest tech companies, and even Microsoft, even Amazon, even Apple. I mean, companies like those are six baggers, up 500% over the last 5 years, and yet they're sitting at the very, very top of the market. So you're getting a much more focused market, a much more tech-focused market, and even that tech industry itself is adapting, it's evolving, and it's warranting higher valuation multiples. If we look back a decade ago, Bill Gurley, used to talk about the 10x revenue club. He thought it was kind of wild to see that certain companies were selling for 10 times sales. And of course, that's gotten pushed up to maybe 20, maybe 30, maybe 40 or 50 times revenue for any individual company right now. Does that mean that they're too expensive because 10 years ago, 10 times sales was considered an expensive stock? No, it means the denominator in the price to sales ratio is evolving and changing, and the market is rewarding a more predictable revenue stream.
So we talk about, sales. And isn't some of the difference that those older companies you were talking about, like when GE sold you a whatever, an oven, GE makes ovens, or an engine turbine, whatever it is, you're buying that oven. And there's no guarantee that the next time you need an oven, whatever that replacement cycle is, call it 7 years, that you'll buy a GE. Whereas a few months ago, very quietly, Microsoft raised its prices on the Office suite, which is largely a software as a service product. And it was a multi-billion-dollar increase in terms of their revenue. And I doubt they lost one customer because of it. When you have that locked-in revenue, is that simply more valuable than even like the brand loyalty of, hey, I drive a Ford and I'm always going to drive an F-150, and then it becomes time to buy an F-150 and you realize, oh my God, it's $30,000 more than like whatever else I might buy? And I say that because with the whole car situation now, like a buddy of mine bought a car this weekend and he bought the car that was available, like not the car that he wanted. Whereas like, I'm not getting rid of Office anytime soon. We're not getting rid of Zoom anytime soon or any of the products we use. It's a pretty locked in revenue for the most part, right?
Yes, the whole game is changing, and the way that investors assess companies is changing too. Right. So if we look back a couple of decades, it used to be the capital was kind of the constraining factor for so many companies. The reason GE was so much larger because it was diversified. It had billions of dollars in its pockets that it could go out and build plants for. Exxon, the same thing for building oil wells. IBM, whatever it was. These really, really large companies had huge advantages because they had deeper pockets of competitors. And so back in the days, the traditional analysis was, what is the company's weighted average cost of capital, right? The cost of what it costs them to raise debt, to raise equity, their overall cost of borrowing money versus their return on invested capital. How can they deploy that money that they borrowed into projects that were incrementally valuable for equity shareholders? But it's kind of changing, Dan. It's not so much in today's software and digital world about who's got deeper pockets. It's about who has got a lower acquisition cost of getting new customers and then who is retaining those customers. It's the Netflix model, it's the Amazon Prime model. I mean, there's countless examples of the world's most valuable companies now transitioning in the digital age and a completely different way of analyzing them as investors.
Hasn't it been sort of a growth at all cost model? Like we've seen this with Netflix and even Disney to a point on the digital side, where nobody's really talking about what it costs Netflix to acquire a customer. They only talk about the bottom number, the how many customers did they add. And the reality is that acquisition cost really, really matters, but it does seem like the market ignores it. Am I missing something there?
It has been that way for a long time because money has been free. And so it was like, hey, go out and juice your returns and borrow money as cheap as you want. And all we care about is your top line growth. I think we're kind of hitting the point of inflection for that, Dan. I think it's going to be much more important, especially in these next 3 or 5 years, for a lot of these tech companies to start showing profits and cash flows. Maybe the quintessential example of this has been Alphabet. Right, Alphabet was just, go grow, the core business, and then go ahead and go out and do these other bets. Go out and have Google X and do all these self-driving cars and these balloons that we're going to broadcast on internet across the entire world. It's kind of like, hey, these are fun little projects. They might eventually be worth billions of dollars, but they weren't super profitable for a long time. Facebook, same example, right? Facebook WhatsApp, Facebook VR. It took them years to even figure out what kind of monetizing strategy to have for these. But now I think we're, as investors, we're starting to say, hey, we want to see the money a lot more. Even Google has got a prioritized list. Ever since Ruth Porat came in, Alphabet, excuse me, not Google, they've had a prioritized list, line item by line item, about what's the ROI of anywhere that they put their money, including share buybacks, which they started in the last couple of years. And so we're getting a little bit closer of an eye on how tech companies are spending their money. I think investors are going to be watching that much more closely in the next couple of years.
It's a problem of size and scope. We've talked about this a lot with Anirban Mahante. If you take the Apple Watch and you made that a Samsung product and it was the same level of success, we would be touting Samsung as this company on the rise. When we talk about Apple Watch, we actually just talk about how it can't move the needle for Apple. So if you're Google, the reality is there's probably 75 Google initiatives we've never heard of that are mildly successful. But when we see them take these giant moonshots, they call them moonshots because that's the only way they could make a big difference to their valuation. So is this one of those things where, as you factor in valuation, do you think about what's the available remaining total addressable market? Because if you're Google, I'm not sure there's that much more advertising market you can capture. And in fact, we've talked about it in a lot of ways. They are facing new pressures from the Pluto TVs of the world. And I'm not a giant fan of Pluto TV, but there's a lot of other places you can put your advertising, Facebook being a good example. Maybe someday Twitter figures it out, though I don't think that's all that likely. So do you look at an Alphabet and just go I don't see their optionality, whereas I see how Apple could get into healthcare or cars or whatever else it might be? How do you factor in valuation?
Yeah, that's the right way to think about it, Dan, is the optionality and the future growth of the company. It's great to say that you're going to go over and take over the world and address climate change. And we're going to fix Earth's climate change problem, which is exactly the master plan that Elon Musk put out a decade ago, right? He said he wanted to adjust Earth's climate change. But the reason that Tesla's stock has done what it is because he executes so well. He found ways to have a mass market electric vehicle. And then he went on and he sold the autopilot feature in advance for people. Just incrementally executes very, very well. And I think a lot of these companies, these tech companies too, we're going to start seeing the execution against the addressable market opportunity is going to be very important. And Dan, we've actually got some examples we're going to talk about on this show of companies that are all considered expensive, but some might be worth it a little bit more than others out there.
We're going to get there momentarily. A couple of minutes, we're going to talk about Fastly, Peloton, Zoom, and Snowflake. On two of those, you're going to talk because I'm not super familiar with two of those. Max Lucas, we'll get to your question in 1 second, but I want to ask two final questions to Simon. Simon, the first one is simple. Are there companies you love but don't own because of valuation concerns?
Yes, valuation always matters. Jumping in too quickly without considering if the market is valuing a company completely out of touch with its fundamentals is playing the hype cycle rather than playing fundamental analysis. Quantum computing, electric vehicles, two perfect examples right now.
Yeah, this is something Max Chatsko talks a lot. He can love a company, but look at its valuation and go, oh my God, everything would have to go right 5 times over. It is a constant theme of sort of his internal musings and on some of this. And we've talked about it on air, the whole 100 billion valuation in biotech stocks that he's done a really nice chart of. There is a public-facing article on our website about that if you would like to go read it. It's one of the recent ones we did, so that should be right at the top. Last question here. How do you value a company when it's no longer based on cash flow or any actual numbers? And I have a lot of experience with this because when you write a business plan, which is obviously something you've done, you're the CEO of 7 Investing, Do you remember the part where you have to like forecast like what happens in year 7 and you're just using like magic exponentials? Like I did that for a company that went public in the late 90s, back when there was no revenue for advertising, and literally like 2012, we're doing $1 billion a day. Like, but like, how do you do that with a publicly traded company without being as silly as I was just being there?
Well, it's about the scalability, right? It's like, how fast can you realistically grow your business? Facebook did it really, really well because they figured out they could just put a couple more ads in everybody's news feed. As long as the ad load wasn't too overwhelming for people, it fell right to the bottom line, and they made a lot more money by doing so. That's a lot easier for a digital company like Facebook, Meta is doing right now, than a company like ASML, who's creating extreme ultraviolet machines to create semiconductor chips. That is very, very specialized. You've got to have the right people and the right components. And every one of those machines cost $150 million in 2 years to make, Dan. I mean, something like that, even though they are completely backlogged, you really can't scale an operation like that infinitely quickly. There's kind of trade-offs when you're looking at valuation of like, okay, where do we stand today? Where could we be 3 or 5 years out? And how is a company actually going to do that? If it's feasible and you see the path, then maybe it is worth a premium valuation.
That is the challenge on all of these. We're going to get to those companies, but let's bring up Max Lucas's question first. I will do my best to read this if you want to pull that up. As we see more and more people become investors and the middle class raise globally, won't we see higher valuations to more and more money chases the same amount of companies? I think that's a very fair question.
Yeah, I mean, the right question is, where is the money coming from, right? Are you putting it from deposits you had in a bank, in a savings account, like we've kind of seen in Brazil for several decades now, and then all of a sudden they've got more opportunities to invest in the stock market now. China is kind of doing the same thing. China equity investors are really on the rise right now. What is cryptocurrency going to take money from? Is that going to take money from growth stocks, or is that going to take money from bonds? I mean, there's trillions of dollars out there, but something like $65 trillion in retirement portfolios, even in just this country right now. Huge amount of money when you think about that. But where is it going? Where is it coming from? And is that going to push the prices higher for existing companies, or is it going to be going more for smaller, growthier companies? Lots of tough factors to consider in that, Max. It's a great question. My crystal ball is a little cloudy on the answer right now.
Yeah, I think overall that's generally probably right, but I do think you see new avenues of investment. And I did a 7 Investing podcast with a company that's sort of democratizing investing in like Airbnbs. And I think some of the rules, I did one many years ago on like micro IPOs, where you could buy just like, I think that one was a share of Eminem's publishing rights. It was like 12% of Eminem's publishing rights. I think you're going to see some really interesting niche investing vehicles. But generally, I do think what Max Lucas said is probably right. We're going to talk about Fastly, Peloton, Zoom, and Snow in a minute. Before we do that, at the top of the program, we shared that after today, we're taking a Thanksgiving break. We are not going to come back with the show until September. And when we come back, it's going to look a little bit different. It's going to look more like today, actually, to be fair. Simon, I'll let you sort of explain this, but we're going to be a little less frequent, and we're going to be a little more focused on one topic, as opposed to sort of the Today Show nature of the show that we've done for the past year or so. Simon.
Yeah, thanks, Dan, for the key up on this. We are going to take a little break for a couple of weeks. We're going to restart our 7 Investing Now live stream on December 1st. And like you said, it's going to have a different format. We are doing some really, really thorough research on this team. I personally put our 7 investing stock pickers against anyone else in the world. It's really, really thorough, and I'm very proud of the work that we're doing. And I want us to start showcasing that a little bit more in depth. And so starting December 1st, our live stream show is going to be less about kind of following earnings, kind of following along with headlines, following along with what's going on in the market today or this week, and more of honing in on a certain topic that each advisor is very, very excited about talking about. And not just talking about, but also answering your questions about. We're going to keep the live stream component about this, so you can ask our expert advisors about the topics that they really, really want to chat about. And so my first topic, Dan, I've already picked it. It's going to be the winners and losers from the semiconductor chip shortage. This is something I put several months into looking at and saying, okay, we know that there's a supply chain issue in the semiconductor industry right now. We know there's only a handful of companies that are manufacturing all of the chips of the world, at least from independent foundries. And then we see companies like Intel who are really, really interested in manufacturing chips for American companies. I'm going to be spending my first appearance on the new show in December talking about a couple of companies I really, really like that I think are winners from that space, and then a couple others that I think I have a lot to lose.
We are looking forward to it. We are happy so many of you are following along. And of course, if you are not a member of 7 Investing, you are making a mistake. You are not empowering yourself to invest in your future. How do you join? 7investing.com/subscribe. You have 2 options there. You can give us $49 a month. We'll take that. That's better for us. But what we would prefer, because it's better for you, is you can pay $399 for a full year subscription. Simon, that's 12 months. If you're using the Hebrew calendar, some years that's 13 months, but we of course don't use that. We still only make 12 picks. That's the one thing I learned in Hebrew school that's delighted me forever, that some years there's a leap month in the Hebrew calendar. That is a ridiculous aside. I apologize for that. We also have a student membership. If you are an actively enrolled student, or you're buying a member for an actively enrolled student, please don't lie to us on that. Please be honest about that. It is $84 a year. We want that next generation of investors to become engaged. I know my son, Simon, has an investing account. He has a custodial account, though. He turns 18 soon enough, so it won't be a custodial account. And we talk about some of the stocks I pick and why, he works at Wendy's. And I don't want to say Wendy's isn't a great stock, but there are reasons I don't love their model compared to why I might like the model at some other restaurants. There's some experiences he's had working there that also enlighten him on it. So it's something I very much like talking about. But we're going to get back to it. We're going to talk about Fastly, Peloton, Zoom, and Snow. Gregory, we see your comment. We will take that later in the show. But Simon, Fastly is a company that, let's just say, there's been a lot of concerns about recently, right? This was a high flyer that maybe has tripped a couple of times. Why don't you take the ball and run a little bit here?
Yeah, so Fastly is improving the performance of websites. Content delivery networks are making sites load things more quickly. And this is really important for edge computing because you want to be as close to the end user on whatever device they're using as possible. And this came out really hot out of the gate, Dan. The IPO was in May of 2019. A lot of people were really excited at Fastly's outsized growth rates. We were typically used to seeing 35, 40, 44% a year annual revenue growth rates. And it was all based on usage of their platform, right? It was based on the actual number of computing requests they were receiving, the number of gigabytes of storage. So it was kind of based exactly with the engagement that their customer group was getting. And I think one of the exciting things that people really loved about Fastly was their presence at enterprise customers. They had around 85 to 92% of any year's revenue was tied to the enterprise, right? These are customers that have $100,000 or more of annual recurring revenue contracts in place. In fact, their average annual recurring revenue contract for even this last year was around $750,000 to $800,000 per customer. So this is the highest part of the market, Dan. And a lot of people really thought that was going to go really, really easily for them to attract mid-market customers as well. But we've seen slowing revenue growth. We only saw 23% revenue growth in the most recent quarter. We saw a transition in the management team, not only in the CEO, but also in the CFO position. And for me, the bigger question about Fastly, back to our original comments we made at the beginning of the program, is how much more can they go from here? If you've already got the largest, most appealing enterprise customers, they're already paying an average of $800,000 a year in annual recurring revenue. Now you're trying to fight it out with a much more competitive market with the mass market. And to me, I just don't think that justifies the high valuations that Fastly received for so many years. And so, JT, let's throw the chart up there of Fastly if we can. This is since its IPO, again, in May of 2019. This is the total return of Fastly stock, which is the green line there, versus the total return of the S&P 500 over the same time frame. Fastly is still outperforming, Dan, but look at all the excitement that we saw about a year ago. A 4-bagger, actually a 5-bagger, from its original stock price. And we've seen a lot of that enthusiasm kind of wane as its growth rates have slowed, as it's finding it a much more competitive market that it's trying to find its place in.
Simon, is this a company that can find its place? I mean, 23% growth isn't nothing. Like, it's slower, but if they could maintain, say, 18 to 25% growth consistently, wouldn't that get people excited again? I think those numbers are going to be difficult, but it's not dead. I think that's fair to say. I don't know if I lost Simon or if I am lost. If you want to share, JT, sort of which one of us froze there, that will let us know what is going on. Simon has frozen. So the challenge here is Simon was going to talk about this, but the next one we're going to talk about is Zoom. And Zoom is a company that actually does have earnings, but it's trading at an incredibly high price to earning ratios. That is more than double Apple, Alphabet, and Microsoft. And I'm going to say, and Simon, you are back. We segged a little bit into talking about Zoom. I set the table at what it's trading in relation to Apple and Microsoft. So if you want to take the ball a little bit, refer to your script, and you can go forward talking about Zoom here.
Sure thing. Well, let me first segue back to my comment about Fastly, which I think is the perfect segue, because I was just about to talk about an outage that Fastly had in the second quarter, just as my screen freezes and I get lost from the program. So apologies for everyone that wasn't able to see me there as I was talking to myself, but I'll continue right where I left off, which is that Fastly had an outage in the second quarter. It upset a lot of those enterprise customers. Dan, your question for me is, can they continue to grow at that outsized rate? And is the stock dead? No, it's not dead, but it's certainly not deserving of those multiples if it's only growing at 23% rather than 44%. And it's also already tapped out the largest of the enterprise customers. And so I think we've seen a kind of retrenchment of valuation multiples for Fastly. I certainly don't think the stock is dead. I think more likely is that it gets acquired within the next year or 2 years.
That when they made the CFO change, it is worth noting that they brought in a CFO who has significant experience with selling a company. Fastly, the problem is the companies that could acquire Fastly would actually be companies that some of its biggest customers would then not want to be a customer. So that is a challenge when you look at, we've talked about this with a lot of tech companies that are sort of doing reasonably well as an island, that if all of a sudden, Amazon owns them, some of their customers go like, yeah, we'll find the next Fastly and go with them, or we'll create it, or whatever it is. Zoom is kind of the opposite scenario, right? So Zoom is a company that has been profitable. We've seen during the pandemic that it's very, very well run, but it's gotten incredibly ahead of itself with valuation. Is it reasonable to say that Zoom might be worth eventually what it's worth now, but perhaps it's not worth that quite yet? I hope I'm putting that well.
I think, Dan, actually, I'm pretty bullish on Zoom, believe it or not. Whereas I was a bit more bearish on Fastly in my assessment just a minute ago, I actually really like the position that Zoom finds itself in today. This is a company that came public right around the same time as Fastly did, April 2019, hits the public markets, and it really shot out of the gate really quickly during the pandemic. There you go. There we can see this is a return of Zoom since its IPO in April of 2019. Really quickly got a whole lot of people on the platform. Of course, because of COVID, nobody's able to report to work. But even still, it's growing revenue 54% year over year. It has 2,278 customers who are spending more than $100,000 a year with it. And that's up 131% year over year. But here's the part I really like, Dan. Those 2,200 customers are less than half of 1% of the 505,000 customers it has that have at least 10 employees. Now, of course, not all of those 10 employee customers are going to go out and spend $100,000 with Zoom immediately overnight. But you see it kind of land and expands, right? It's got now webinars that it's allowing people to do. You're upselling, you're adding more features to your account that's already there. It tried to go out and acquire Five9 for the call centers. Ultimately, Five9's shareholders didn't want the deal. They thought they were undervaluing the company, but that's another vertical it could get into. You can add more licenses for just $20 a month. This is kind of still, in my mind, the perfect land and expand model that got its foot in the door with so many companies, visionary CEOs, and a lot of optionality. We've seen the stock selling off, but I kind of like where Zoom is today, and I think it's got a bright future ahead of it.
I've talked about this a lot. All of the small groups and small businesses that integrated Zoom might use it less, but they're not going to get rid of it. And the example I always give is my mom's tap dancing class. My mom tap dances, and they went to full remote. They're all 70, 80, whatever. They went to full remote during the pandemic. But now that the pandemic is lessened, over is probably not the right word, but lessened, they have in person, but they still broadcast on Zoom because they're old and some of the people can't come. We've worked places where meetings were always on Zoom. Even if sometimes you were in the building, you might not be able to get to where it is. That happened when I worked at Microsoft, where like sometimes you would use there. And bringing up Microsoft, everyone asked the question, oh, well, is Zoom in trouble because Microsoft and Google are in this space too? And I think the reality is it's a lot like streaming, that there are room for multiple winners. And I don't know if you've used the Google or the Microsoft product, but it is not as good as Zoom. And I think the fact that Zoom is really focused in, my wife works at a nonprofit, and they've done those webinars, they've done breakout rooms, they've done things that you could probably do in some of those other platforms, but Zoom has done a really good job. I've been impressed with this company since day one of the pandemic, where do you remember when people were having security issues, they were getting Zoom bombed? And all of a sudden, the CEO of Zoom, whose name escapes me, I apologize for that. And he came out and said, we're going to stop everything we're doing for 90 days and focus on security. Well, that is the kind of CEO response that makes me think this company will figure it out. I think there's a tiny bit of danger of Zoom becoming a generic. It's certainly my biggest concern about Teladoc, where every platform is good and you just don't know whether you're using Zoom. But I actually think the brand name is really valuable. And I'll give you the last word here, Simon. But I think, again, ahead of itself, but probably worth holding if you own it now, and worth keeping an eye on, because there's every chance there'll be some valuation fluctuation here.
And the last word, Dan, on this one is predictability. We talked earlier in the program about you're going to get a better valuation if you can see into the future of how well a company is going to do. $2.3 billion of remaining performance obligations for Zoom. That's fantastic. And only 69% of that is coming within the next 12 months. They've got a really nice roadmap into the future, and it's going to keep getting a nice valuation premium with that kind of predictability of its future revenues.
They also have not figured out hardware, but I don't think it's impossible. I think they went very expensive, and that didn't make that much sense. Something closer to the Facebook portal as a dedicated Zoom platform, who knows what they're working on. But I do think there is some optionality. I mentioned Teladoc there, but there's a lot of things that could be done on a secure Zoom platform. Think what Lululemon does with Mirror in terms of classes and other things, and doctor's appointments and mental health. And there's a lot of runway here. And I think when you have smart management, that goes a long way to believing they'll find that runway to expand. We're going to talk about Snowflake next. This is a company I know nothing about, and there are no notes in the document. So Simon, I'm going to let you run with this. I know you've got some charts here, but tell us where we stand on Snowflake. Right
Dan,
now.
I can't put you on the spot and just have you talk about Snowflake with no prep for this one, huh?
Yeah, this is one, like, there are some management reasons that aren't necessarily management skill that make me not that interested in this company. Not the active management, the sort of powers above that. So this is not one I've followed all that much, but I know it's one that's a lot of people have been really, really high on. This has been an absolute fast growth company.
Sure, yeah. Frank Slootman coming from ServiceNow, really a great executor, really a no nonsense kind of guy. Go out and get it done. Comes to Snowflake because he worked with two of Oracle's engineers to do kind of this multi-cloud architecture that would allow companies to have multiple cloud providers and then interoperable with each other, right? So you can have Amazon Web Services, and you can have Azure, and you can have Google Cloud, all working together through Snowflake as the layer on top that's doing your computing, so your processing of everything you want to do, doing your storage, and then building applications that will work with any cloud provider you have. What an advantage. What an advantage as everything is moving to the cloud. Great company, great technology, right at the right place at the right time. We just talked about remaining performance obligations for Zoom. This is something else that's very, very strong for Snowflake as well. Snowflake charges on a usage-based model, again, also based upon storage and based upon the processing that you're doing with them. And so their revenue kind of reflects how engaged their customers are. So when you see that you're seeing remaining performance obligations of $1.5 billion, up 122% year over year, and you see a net retention rate at existing customers of 169%, meaning existing customers are spending 69% more on its platform this year than last year, and your revenue is derived directly from how often they're using it, man, that's worth the premium in my book, Dan. That's the kind of company you want to invest in. And so let's show Snowflake. Let's show the chart for it. Here we are. Snowflake, it's volatile. You can see kind of the ups and downs it's gone through since it had its direct listing in September of last year. Again, pretty recently public here, only a couple of months of being a publicly traded company. But this is one that in my mind is perpetually overvalued. They pay a lot of stock-based compensation, but I think it's worth the premium, Dan. This is the cloud is still, workloads are less than 20% of enterprise workloads globally are being used in cloud-based applications. That's a huge addressable market to grow into, and you kind of want to invest in the leaders in this space. I'm a big fan of Snowflake.
So before we pivot to Peloton here, I think it's important to talk about that you really do need to look at that number you said, because more and more things are moving toward the cloud. So some of these are just going to have a bigger sandbox to play in. And if it's a good product, like, look, there is no company that's going back to like roomfuls of servers unless there's some like really weird security reason why you would do that. So the opportunities here are growing, but I think it's fair to say with any of these three that it might be lumpy. You might see, oh my God, Snowflake had 80% growth one quarter and 7% growth the next. And some of that is the nature of internet traffic patterns. Look, if the weather is bad this winter, internet traffic goes up. And I know that sounds ridiculous, but it's actually like pretty meaningful in terms of how some of these companies operate. And the next one we're going to talk about, Peloton. If the weather is bad and you can't go to the gym, you might buy a Peloton. So we saw the beginning of the pandemic, gyms closed. You know, Simon, I work out, maybe it doesn't look like it, but I work out pretty regularly. And yes, and I am ridiculously strong despite not being, but my gym closed in my building during the pandemic. And I bought like an array of like really stupid gimmicky exercise equipment when I should have just bought a Peloton or something like the Nordic Track machine I bought a few weeks ago. So, but Peloton has struggled. Their sales have slowed down quite a bit. And the question here, and I'll throw it to you, is, are they just like a Disney Plus or a Netflix? Do they just pull a lot of growth forward and there will still be 6 months from now a new audience of relatively well-off people who want to buy a Peloton so they can tell their friends about it? Sorry, everyone gets mad at me when I say that, but the whole Peloton marketing campaign is about status. There's a lot of that's part of it. But is there an audience for this? Because I don't buy this argument, oh, everybody's going back to the gym. They're not going to. People who go to the gym still work out at home. People who spend money on workout equipment are probably going to spend money on workout equipment and just use it less often. So I tend to be of the, just give Peloton a year until demand recovers and they get into some of the high-end apartment buildings and other places with their Precor bikes and the other options they have there. I'm actually like light bullish on Peloton. I think it's going to be really ugly for a while, but I do think when you are the best-in-class brand, that will pay off. They've made some mistakes. Cutting prices, Apple never cuts prices. Like that to me is them panicking a little bit, but I do think they'll figure it out. Simon, I don't think you have a Peloton or frankly time to ride a Peloton, but why don't you jump in with your thoughts here?
I think that how much time do we have to ride a Peloton is the right question, because we're capped on the number of hours we can put in every day or every month. And Peloton needs to protect that brand, like we just talked about. It's kind of the same as Fastly going after the high end of the market with enterprise customers. Peloton went after the high end of the market if we wanted to pay as much money as they were charging for the bike. And I think they found out, the pandemic certainly played to their strengths. It was kind of the perfect storm for them. But this price cut that you just mentioned is exactly what they needed, the tough pill to swallow, that everybody wasn't going to pay as much as they wanted to charge. And so it wasn't a lower feature bike. It was just a price cut for the same existing bike. And again, 78% of sales right now is coming from hardware. Only 22% is coming from subscriptions. And so Peloton needs to make that shift. They've already got the high end of the market that wants to work out an average of 20 workouts per month right now. That was 25 a year ago, by the way. So it's actually down a little bit in year-over-year comparisons. You still got the diehards that want to work out 25 times a month. But I think we're getting Peloton's figuring out, what does the mass market look like? What are the people who aren't going to be working out quite that often willing to pay for a Peloton and willing to pay for a subscription? And was this company overvalued when kind of the expectations were very, very high? I think it probably was, Dan. If we put up the chart really quickly of Peloton, since its IPO in September of 2019 for this one, I think the question for this one is how big is its addressable market truly? You can see in late 2020, early 2021, stock shoots out like a cannon, multi-bagger written all over it. And kind of there was a ton of expectations. Dan, I think we even hit a $50 billion market cap for Peloton at some point here. It's come much more down to earth now as people are starting to figure out, all right, how many subscriptions can we truly get? Because that's where the cash flows are going to be coming from.
So the problem here, and it's we did a 7 investing now on Peloton with Anirban Mahante. I would argue that this is a good business. It's not necessarily a good investment. Doesn't mean that it isn't, because there is some optionality here. The Peloton interface is unbelievably good compared to their competitors. I have a Nordic Track because I wanted a strength trainer, and iFit, which is the name they're going public under, is awful. It's not intuitive. And a lot of it is built around, you have this device, so do every exercise using this device. When it's like, wait a minute, why do I need the device to do a push-up? Like, Peloton has really made its classes fun. It's integrated sort of the camaraderie, the you're going to do this live. I think there's some value to that. Peloton can launch a rower. I think Peloton, which did launch a strength training, sort of a camera that can read what you're doing, I think they made a mistake there. It's a low-end product why aren't they either buying Tonal or competing with Tonal? I do think eventually they'll have a strength trainer, but if Tonal can get $4,000 and Nordic Track can get $2 million, I feel like Peloton could easily be in that space. This is a company that I think is kind of the Tesla of its space, not in terms of how well it's going to do, in terms of how people feel about the brand. Ask any of your friends who have our own Dana Abramovich will go, wax rhapsodic about this. And that's sort of not Dana's personality. I've never heard her mention like a lot of other companies. So it's really her going out of her way to say, and I've had that experience with many of our mutual friends. So I do think Peloton will figure this out. I'm just not sure personally I would park my money there while it does, because I do think there's the possibility that this just becomes a nice, steady business and the value slips enough at some point that Apple buys them. And I really think these are Apple products. And so that's probably not going to happen. It's not Apple-like at the prices it would be, but I do feel like they're making products that are equal to what only an Apple or a Tesla are delivering. And that doesn't necessarily fit in, say, like the Alphabet portfolio next to Fitbit, which is like a pretty, and I'm wearing a Fitbit, but it's a relatively crummy product compared to the Apple Watch. Simon, any last word here before we take one more question and then wrap things up?
Yeah, I think it's a neat company, Dan. I think it definitely has its place in the market. There are certainly people that work out 7 or 8 hours a day like Dan Klein does, but I think that there's a limited number of those people that want to buy the bike and then they want to buy the treadmill and then they want to buy the rower and, assemble your own Peloton gym in your own home. I think that that's a limited market out there, and there's only a limited number of hours per month that people want to work out. Again, the topic of today's show is tech valuations. I think this is one that really got ahead of itself. It's kind of coming back down to more realistic expectations this year.
It is worth mentioning that if you spend $2,000 on a bike or $3,000 or whatever, depending which model you buy, which is why I think the price drop was a mistake, you are not likely to cancel that subscription even if you don't use it. So here's the reality. I'm not worried about the overall number of being less classes. Of course, there's going to be less classes. We were locked in our houses. Now, even if you're not going back to the gym, you're still like walking places that you weren't. And obviously, we live in places that are perhaps more walkable than some parts of the country during the winter. But I wouldn't be surprised if we saw a really good holiday season for Peloton. I think it's actually pretty difficult right now to figure out what people need. Like, normally I'd buy my wife some like gift cards to places to get clothes. Who needs clothes? Like, she doesn't go to work anymore. So like, I think you're going to see, and I'm just guessing, I think this could be a good fourth quarter for Peloton. But again, the theme of this show is valuation, and valuation absolutely matters. Simon, there's a question here from Gregory. I don't know if you want JT to bring it up or you just want to sort of like answer it in a roundabout way.
Yeah, no, go ahead. Go ahead, JT. You can bring this one up. Gregory, thank you, Gregory. Gregory Spira for asking. So back to the beginning of the program, we were talking about my first kind of deep dive that we're going to talk about on the live stream is semiconductor companies. And Gregory asked, so these semiconductor companies you really like will be in addition to your official picks? Yes, that is correct. These are every one of our live streams. We're going to be offering at least 2 or 3 companies that we like. related to the topic that we're talking about. And it's going to be a back and forth discussion, right? I would love everybody to ask me about the companies that we bring up in these live streams. But this is not me broadcasting, hey, this is going to be my pick for this month or next month. We don't do that. We want to reserve that behind the paywall for our paying subscribers out of respect that they're paying us for access to those picks. But this is something that's certainly on our radar. You know, I'm not just kind of throwing darts at the companies I like. It's a methodical reason why I think that they're going to win.
Yeah, and part of the research process is what we are narrowing down all the stocks we like to the one pick, the one top conviction we have that we think our members should own. So that doesn't mean in my personal life, I mean, I'll say I buy multiple 7 investing picks every month, some of which I've researched and some of which I haven't. So there are absolutely companies we really like or can talk about authoritatively because we've done the research that didn't quite make the cut. So part of this is a way to use some of that deep dive research we're doing. And I can't tell you how many times at one point I thought, oh, this is my pick, no question. And then you start digging in and you're like, oh no, like here's something I really don't like. Here is a red flag. So really going to be interesting. We will be back on December 1st. You've been watching 7 Investing Now. I am Dan Klein. He is Simon Erickson. If you would like to get in touch with us, you could send us an email at info@7investing.com. That's usually Steve. Thanksgiving's the best day to email Steve. Like he's got that I am kidding. We answer email every day, but maybe during the holidays, it won't be quite at the machine gun pace Steve answers these things. Because obviously Steve can eat a lot of turkey, and I'm guessing Steve's smoking a turkey. He's probably doing something much more interesting than the rest of us. There's probably wild game involved. If you would like to follow us on Twitter, we are at 7 Investing, and Simon will tweet out later from at 7 Investing how you can join our Discord channel. Our Discord has exploded. So we have an area for members. And that's conversations about our picks. It's insights that would usually come during a members only call. It is also a place where non-members can just have stock talk, and it's a safe environment. It is, maybe not the same as putting it out there on social media where, your boss or your friends or other people might be able to see it. It's a respectful environment. Please come in and wipe your feet and respect all the other investors. But we will share out from our 7 Investing account how you can join that until December 1st. JT Street, Sam Bailey, thank you behind the glass. We will see you then.